Hello, welcome to the European Open briefing for Wednesday, December the 7th. I'm Rafi Bajajan, currency analyst at XM.com, and we're going to be looking at what's happening in the currency markets today. So the main news this morning is we had some GDP data out of Australia. It showed Australia's economy contracted unexpectedly. So this led to a bit of a dip in the Australian dollar versus the US dollar. The euro, on the other hand, is much steadier this morning. As the traders take a cautious approach ahead of tomorrow's ECB meeting, and also as the initial reaction to the Sunday's referendum in Italy subsides. The US dollar is also steadier. We're seeing the greenback consolidating from its recent strong rally as traders prepare for the next week's Fed meeting and as well as the ECB meeting. Oil is down again for a second day, mainly because investors are doubtful whether the agreed supply cut will be enough to offset the huge supply cut. So let's start with the Australian dollar. We can see that that big dip earlier today was down. It fell around 0.8%. It's now down just around 0.4% on the day. Although it did manage to hold about 0.74 level. Australia's economy unexpectedly contracted by 0.5% quarter on quarter. Expectations were that the economy would expand by 0.3%. The year-on-year rate fell from 3.3% in the second quarter to 1.8% in the third quarter, and that's the lowest since 2009. And the main reason why growth was weak because all of the business, consumer and government spending, they all fell during the quarter. Although the RBA does expect for growth to pick up next year, it does nevertheless put back on the table another possibility of another rate cut. The RBA had taken a more neutral stance recently, and so this negative growth in the third quarter once again it could lead to RBA shifting back towards a more dovish stance. So let's move on now to the euro. We can see that euro has been pretty flat since midday yesterday. The euro is holding quite comfortably above the 1.07 level. The investors are slightly optimistic that Italy's troubles won't become they won't escalate. They're hoping that the Italian government will approve the state bailout for the country's third largest bank, which is in a bit of a trouble. They're also hoping that the Italian president will not call fresh elections until the end of the current parliamentary term, which expires in 2018. So they're being fairly optimistic. That's benefiting the euro. Also, we have the ECB meeting coming up tomorrow. The ECB is expected to extend its QE program. There is some wariness among analysts that the ECB may signal that it may start to start tapering its QE program after the next extension. So we'll see what will happen tomorrow, but for the time being the euro is fairly steady, and so is the US dollar, although against the yen the US dollar is doing much better. It's yesterday it fell quite a bit below the 114 level. Now it's back above the 114 level. With the traders are seen as being reluctant to take fresh positions before next week's FOMC meeting as well as the ECB meeting tomorrow. Also, another factor that's holding back the dollar at the moment is that the bond sell-off that took place since after the US presidential elections, that's eased back a little bit, and treasury yields have been steadier in recent days. So the US dollar is unlikely to make fresh gains without any further increases in treasury yields. In commodities, oil, the oil rally appears to have fizzled out for now. Analysts are skeptical whether, first of all, whether or not all OPEC members will fully implement the agreed cuts, as there is some hesitation among some members, even though they've agreed to it. Also, analysts are doubtful about whether the the size of the cut is enough to make up for the huge supply glut currently that's affecting the market, the oil market at the moment. So we're seeing since yesterday, US crude oil here has been trending downwards. It briefly well, it has managed to hold about $50 a barrel for the time being. So over the next few weeks, we will see whether or not non-OPEC countries will also sign up to the agreed cut. Before we go, let's have a quick look at the pound, because the pound yesterday was at a 2-month high. It's fallen back a little bit. It's back below the $1.27 dollar level. Today we have a debate in the British Parliament where MPs will discuss the timetable for the triggering Article 50. This is not the same as the actual triggering of Article 50, so they will just be debating about the proposed timetable. The UK government has been forced to publish some details of its Brexit plans because there is a lot of anger by British MPs about lack of clarity and lack of detail by Theresa May, so that's forcing the government to allow a debate in Parliament, and MPs will vote on this on the timetable, and they are expected to approve. In the meantime, we still have the UK Supreme Court is to enter its third day of the hearing of whether the government can trigger Article 50. As we recall, the British government is appealing against the High Court ruling that forced the government to have Parliament have its say. The Supreme Court will decide whether it will overturn that High Court ruling. So the hearing will last 4 days. Today is the third day, but it's unlikely we're not going to hear what the Supreme Court has decided until early next year. So that's likely to keep traders in suspense until then. Before we go, let's have a look at today's calendar. We can see the GDP data out of Australia earlier today. We also had industrial output data out of Germany that was weaker than expected. Expectations were for an increase of 0.8%. It came in at 0.3% in October. We have UK Halifax house prices coming up later, as well as UK industrial output and manufacturing production. It's going to be quiet today for the US. We only have the JOLTS job openings. But in Canada, we do have the Bank of Canada's latest rate decision coming up later. They're expected to hold rates at 0.5%. That's it from me. Thank you very much for watching, and have a great day.